Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. We're talking about the multifamily industry. Now we're going to talk to Jim Schroder. He is a partner and CFO with Tribridge Residential. They have $1.3 billion of multifamily property under management in the U.S. He's here in Studio One with us. Jim, thanks for being with us.
You bet. Great to be here.
Well, we appreciate it. And we talked earlier to Nick Fitzpatrick with Axiometric, and he said in 2015 overall the U.S. had a 4.9% increase in rental rates, which is great, and the news has been so good for so many years. You guys are on the ground level. You guys have the communities, and you're tracking things like tenant traffic. So I'm curious, what are you seeing on the ground level right now for tenant traffic? You see an adjustment?
Absolutely. And so it's more than anything, it's an adjustment in trends for how people shop for apartments. It used to be they would come up with their list and then they go visit 8 to 10 different properties. Today they try to do as much of that work as they can online. And so it's reduced. They'll only visit 3 or 4 properties. And so what that means is traffic's gone down slightly, but that doesn't mean the demand has gone down. The demand just spends its time in research more online, doing the online chats, doing the online videos and photos, and figuring out which amenities are at which properties and narrowing their list down from there.
That's interesting. So you're not really seeing a fall off on potential tenants at all yet?
Absolutely not. Yeah. The demand in our markets has been phenomenal. And so you mentioned the 4.9% nationally in terms of multifamily. In our markets, we've seen as high as 7 or 8 here in the Atlanta market. Charlotte, we've seen closer to 10 to 12%. Specifically, one property had 15%. And really, it comes down to coming up with the right property that can ride off the coattails of the adjacent properties. And so you have a new development right next to it, getting $1.60, $1.70 rents, and our property we bought with $1 rents. And so without doing anything, we can just get organic rent growth that pushes up to $1.30. It's been fantastic.
That's fantastic, and you guys do a little bit of everything, right? You've bought B and C, you've converted B to A communities, and now you've even bought brand new communities, even before they were leased up. Tell us about that.
Sure. So as you mentioned, we invest up and down the risk spectrum, and so we're always looking for our own dollars and our investors' dollars. Where can we find the best risk-adjusted returns? And over the course of our history, the best value for that was B properties, turn them to A. Well, those deals have been priced up. Everybody's trying to do that. So we wanted to stay a step ahead of the investment herd. Where could we do that? Everybody's developing and building new properties. And so what we started to do, reached out to many of those developers and relationships that we have with our fellow developers and say, we know you want out of this investment. We know you want to lock in your profit. But there's a lot of risk on the table. You have to lease up the property. We don't know what's going to happen in the geopolitical world. We don't know what's going to happen with interest rates. You can lock in your profit today, and we'll buy it based on you're only 30 or 40% occupied. And basically, we've been very successful with that over the past year or two, and basically lock in specific criteria where they have to reach a certain threshold of leasing. And it's been a phenomenal program for us. We've done it in a number of locations.
That's great. And you mentioned, new supply, and I think that's a big part of the equation, right? That everyone's a little concerned with. There are more new supply coming online now. How you guys have a concern about it? What do you see? So
from a macro standpoint, you can look at a few cities and say we start to get concerned about the supply coming on. But then you really need to drill down into the submarkets. And so many investment institutional groups have said we can't invest in Nashville, there's too much supply coming on. Well, if you dig deeper, a lot of it's all within the Gulch or the Germantown neighborhood, 2 very attractive hot markets. Well, if you avoid those particular areas and invest where there's still very strong demand, that's where you can see great success. And so it really comes down to knowing the specific submarket you're in and ensuring you're avoiding those that have significant oversupply coming on.
That's a good point. And then one of the things that's impacting new supply are the rise in construction costs. What do you guys see there, and how's it impacting the market as you see it?
So the rise in construction costs is definitely one of the biggest factors that's going to be limiting supply in the coming years for new development. Typically, developers always overbuild. If you look at a real estate cycle, the boom and bust, the reason the bust takes place is everybody keeps building until someone gets burned.
Right.
Well, you can't keep building today because of the construction prices. To be specific, we're having to build in over 1% growth in cost per month.
Per month.
And so if you compound that, you're well over 13% in terms of annual cost escalations. And so it's becoming very difficult to do development deals. And so one thing we've done to address that is we've tied up a number of properties over the past few years where we locked in a low land basis. New property values for land has increased substantially, in some cases doubled over the past year or so. So our new competitors coming in, they have a significantly higher land basis than we've had, and we're able to come in and build. Obviously our costs have escalated as well, but our basis is much lower due to that land.
That's a fantastic move. And so the rising construction costs, I like your point there. It should keep a lid on some of the new supply, because the numbers are not going to work. You get an increase in the land price, you get an increase in the construction costs, and then pretty soon you're just not going to get the rent levels for new supply. Should help the apartment market, should help cap rates and values. We're going to talk more about all that, so stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.